Managing an options trade can be a very frustrating and intimidating activity because there is virtually an unlimited number of ways that you can potentially adjust and manage an options trade. To help simplify options trading management, I'm going to walk through 5 simple but powerful trade management techniques in this video that you can consider using with virtually any options trading strategy that you're implementing in your account. You could implement 1 or 2 of these techniques, or you could implement all 5. It's really up to you and how you want to use these techniques that I'm going to discuss in this video. But like I said before, you can apply these techniques to pretty much any options trading strategy that you will ever trade. So let's get started. The first and most straightforward trade management technique is, of course, using a profit target. A profit target is a very simple trade management technique because as soon as you enter the trade, you should have an idea of when you're going to close that trade if it works in your favor, and you can even set a GTC or good till canceled order to close that trade as soon as it hits your profit target. As an example, if you purchased a $25 wide call spread and you paid $10 for that call spread, the most you can lose on that trade is $1,000, and the most you can make on that trade is $1,500 in profit, because if that $10 wide call spread increases to $25 in value, that will be a $15 gain on the call spread, and when you account for the option contract multiplier of 100, you'll get a profit of $1,500 per call spread that you purchased. If you wanted to close the trade at 30% of the maximum profit potential, that means you would be closing the trade when the profit on that spread reached $450, since the maximum profit potential is $1,500, and if we multiply that by 30%, we get a profit target of $450. That means you would try to close that trade as soon as the spread's value reached $14.50, since if the spread's value goes from $10 to $14.50, you will have a $450 profit for every call spread that you purchased. On the Tastyworks trading platform, you can actually create an order to close your trade at a specified profit percentage by using the profit target feature right on the portfolio tab. The second trade management technique that you should be using when trading options is using a loss limit or loss threshold. For example, let's say I bought the 3100, 3000, 2900 butterfly in SPX with 60 days until expiration. Let's say I paid $27 to enter this butterfly position. Since I paid $27 to enter this butterfly position, that means I actually had to spend $2,700 to purchase this butterfly, and that means my maximum loss potential in this case is $2,700. If I wanted to close this position when the loss was 50% of the maximum loss potential, that means I would close this butterfly if the loss got to $1,350, which is 50% of the $2,700 maximum loss potential. That means if this butterfly spread went from $27 to $13.50, that means the market moved in either direction against me, and therefore that butterfly position got cheaper because the probability of that butterfly spread expiring with value has therefore decreased, and that is a much more unfavorable position for me to hold. So in this case, I am using a loss limit to call it quits on this position, salvage the value that is currently still in the butterfly spread, and move on to the next trade. For undefined risk positions, I like to use the entry price and an increase from that entry price to determine when to close the trade at a loss. For instance, if I sell a strangle for $10 and I want to close the strangle if I reach a 100% loss on the premium received, that means I'm going to close the strangle if the entry price is doubled. That means I'm going to close the strangle if the strangle's price doubles from my initial entry price of $10. So in other words, if I sold a strangle for $10 and the market moves up or down and that strangle's price increases to $20, that means the increase was 100% from my entry price, and therefore I have experienced a 100% loss relative to the premium received when entering the trade. And therefore, since that was my loss limit before entering the trade, I'm going to close the strangle for $20 and I'm going to move on to the next trade. I'm not going to think twice about it. The third trade management technique is to use delta to determine when to close an option position. There are 2 ways that you can use delta to manage trades. The first way is to actually monitor the delta of a specific option in your trade, and the second is to actually monitor the position delta of your entire position. So in the first approach, you're actually looking at the delta of a specific option in your strategy to determine when to close that trade. And in the second approach, you're actually looking at the position delta, or your trade sensitivity to changes in the underlying stock price, to determine when that trade should be closed. In the second instance, you're closing the trade when the directional exposure of that options trade has increased to a level that is no longer safe in your eyes. In the first approach of looking at an options delta in your trade to determine when that trade should be closed, you will periodically be checking the option chain to look at the delta of that option, and based on that delta, you're going to make a decision whether or not to close the trade or to continue holding it, because the delta is still within the threshold of holding the trade. As an example, if I sold a call spread with the short call at 35 delta and the long call at 20 delta, maybe my delta-based management approach for this short call spread would be to close the call spread if the short call's delta reaches 50. That means the stock price has to increase for the short call's delta to increase from 35 to 50, and at that point, that spread is much closer to the stock price, and in this case, I'm using the delta of the short call to indicate to me when I should close that trade. In the second approach of watching your overall position's delta exposure, you'll be focused on the portfolio tab, and you'll be looking at the delta value that is listed on the portfolio tab, since that delta value is going to give you your position's overall delta exposure or expected profit and loss with a change in the stock price. For instance, if you sell an iron condor that starts off delta neutral and you want to close the iron condor when the directional exposure gets to plus or minus 15 delta, you'll be periodically checking the portfolio tab, and as soon as your short iron condor's position delta gets to plus or minus 15, you are going to take off that iron condor, or you're going to implement some adjustment strategy to bring that delta back closer to neutral. In both approaches, you're using delta to manage your trades, but in two different ways. The fourth trade management technique is to use theta to determine when to exit an option position. If you're not familiar with theta, theta tells you how much your option position is expected to decay on a daily basis. If you are selling options, theta will be presented as a positive number because as the option position loses extrinsic value through the passage of time, the decrease in that option position generates profits for you as an option seller, which is why theta is presented as a positive number. If you're an option buyer, your position theta is going to be negative because as an option buyer, you are going to lose money on your position as the extrinsic value comes out of those options as they approach their respective expiration dates. In this particular rule, I'm going to approach it from an option selling perspective since I primarily sell options as my core strategy. As an option seller, my positions start with positive theta, but as the stock price changes, so will the theta number of my particular option positions. That's because as the stock price changes, the stock price will move more in favor of the position or more out of favor of the position, and therefore the expected decay of that position will change based on whether or not the stock price moved further into my profit zone or away from my profit zone for whatever strategy I'm trading. For example, when you're buying a butterfly, the position's theta will typically be highest when the stock price is right at the short strike of the butterfly because that is the peak profit zone of a butterfly strategy, and therefore as time passes, that position is going to gain a lot of value relative to if the stock were outside of the butterfly's strike prices, in which case the butterfly will probably not be gaining much value as time passes since the stock price is not in the peak profit zone of the butterfly position, and in most cases the butterfly will actually be losing value as time passes, and that will be indicated through negative theta. So the way I would use theta in managing a position is that if you are a short premium trader, meaning you're primarily selling options as your strategy, and you see your position's theta go negative, that could be an indication that you should close the trade because with negative theta, the passage of time is no longer benefiting you, and as an option seller, the passage of time is one of your greatest allies, and if that is no longer on your side, then it's probably time to close the position and move on. Therefore, taking whatever value you can get from that position, taking the loss, and moving on to the next trade. If the passage of time is no longer working for an options trade, then holding the position becomes much more of a gamble. The fifth trade management technique that I'm going to discuss in this video is called time-based management, or what I like to call time-based management. Time-based management is simply closing an options trade after a certain amount of time has passed, and therefore you're protecting yourself against holding the trade for too long, and especially holding the trade as it gets closer to expiration, because the riskiest time to hold an options position, especially a short option position, is when the position is approaching expiration and only has 1 to 2 weeks left or even just a few days left before it expires. During those times, the option position will be highly sensitive to changes in the stock price, and therefore your position's P&L will also be highly volatile relative to changes in the stock price. And volatility with your P&L is not something you want, because as an option seller, you typically want slow and steady profits to come in. You don't want to have huge swings in your P&L on a daily basis as the stock price is increasing or decreasing. The logic behind this management technique is that the closer an option position gets to expiration, the more volatile and sensitive the position's profitability will be relative to changes in the stock price, and volatility in the position's P&L is not a good thing. I typically sell options with about 60 days to expiration, and my time-based management strategy is to close them after about half of that time has elapsed, which means I'm going to close the trades after about 30 days in the trade if it gets to that point, which it usually does not, because I'm also implementing the other trade management techniques that I've addressed in this video. So usually one of the other trade management techniques is the reason for exiting a trade, but time-based management, or exiting a trade after a certain amount of time, is somewhat of a safety net management strategy that protects me from holding a position close to expiration, at which point it will be highly sensitive to changes in the stock price. If you enjoyed this video, please go ahead and give it a like and leave a comment down below letting me know what you enjoyed about this video. I'm Chris from Project Option, and I will see you in the next video.